everybody. Frank Lapp here with eXp Realty. I'm here with Tim Hart with Vandyk Mortgage. Hey, Tim.
Thanks for having me, buddy.
Thanks for coming. I appreciate it.
Yeah.
Tim, the reason I have you on today, we were talking about it a little bit before, but I get a lot of people asking me about buy downs. There's all different kinds of buy downs, right? I think there's a couple. There's a 3-to-1, a 2-to-1. I think you guys do a 2-to-1 buy down, right?
Yeah, we have a 2-1 buy down, right?
Okay.
Yep.
So can you kind of explain, just a quick summary of what the 2-to-1 buy down is for clients, both buyers and sellers? What does that mean to them?
Yeah, sure. And so again, thanks for having me. You do a great job, Frank, and I appreciate the chance to talk to you and your sphere of influence. So a 2-1 buy down. First off, this can be done for a conventional FHA or VA, just so you're aware. So all three of those loan types. And what a 2-1 buy down is it basically means that the seller is going to agree to help the borrower buy down the rate. Okay, the seller has to pay this amount. And what happens is, I'm going to use just to use round numbers. I'm going to use 7% when we're talking about this. Okay. So just use a conventional mortgage. That borrower that will qualify for a 7% 30-year fixed rate. And again, this is just an example. With a 2-1 buy down, what that means is that the seller can contribute a certain amount of money to buy down that borrower's rate for the first 2 years. And what happens is, so if you have 7% 30-year fixed, that's your rate. And the 2-1 buy down means in the first year, that rate's going to start off at 2% below that 7%. So whatever your note rate is, 2% below that's where it's going to start. So in this example, 5%. Right. So 2-1 buy down. So for the first year, that rate is 5%. And so then what happens is the second year, the one part, it goes below 1%. So now you go from 6. So starts off at 5, then goes to 6% in the second year. Then once you finish the second year, you go to your 30-year fixed, 28 more years left of 7% as the rate. And so can I keep going about how the costs work out, or do you want to kind of break that down?
Yeah. So there's a lot of questions out there about it, and what would a typical buy down? In other words, is it a certain percentage of the loan amount that's due to pay down that percent? So go ahead if you want to touch on that.
Yeah. So what happens is, and again, just a reminder, the seller has to pay this. This isn't something the buyer can do. This is a seller incentive, right, to have you buy their home. And what happens is when we say, okay, well, it's going to be a buy down, in essence, what that means is that first 12 months, right? We're just going to use that example. First 12 months, that payment's at 5%. Okay. So there's 12 months of payments made with a 5% note rate. And let's just say it's a $400,000 loan. All right. It's a $400,000 loan. They're paying 5% for that first year. But what happens is, so if that payment, and I got it written down right here, that payment is, I'm going to use round numbers, $2,150 a month at 5%, 400,000. Then what happens is you have your 7% payment at 400,000. That would be $2,660. All right. So that's about a $500 swing in the payment.
Yeah.
So those 12 months of payments, the difference between the 5% and the 7% is subsidized by the seller. So if that makes sense, that's like $6,000, $6,100 or so for the first year that the seller has to pay up front at closing. Okay. Does you kind of follow me there?
Yeah. So basically it's it goes they prepay it
at closing. Right. And the lender, so what the lender does is they say, okay, the first year is going to be, in this example, $6,000 to cover the difference in the rates, which gives the borrower this cheaper payment for the first year. Second year, it goes up 1 more percent, right? So that cost is lower to the seller. And in this example, it's around $3,100. Okay. So what'll happen is when you add those two together, that's around $9,200 for the first year, and the second year for the seller to contribute and buy down the borrower's rate for the first 2 years. That money is collected at closing. It's collected at closing, and the lender holds it into an escrow account. And then every month that borrower makes that payment that's cheaper than what they're supposed to be paying. the seller pulls in the money from the seller to make that payment whole. And they do that for 2 years. And then again, it goes into your 28-year mortgage.
Okay, yeah. So that kind of answers one of the questions, is that that does need to be paid up front, and it comes out of the seller's proceeds, right? So
Yep.
at the closing table, it will be a credit at the closing table, whatever that amount is. And okay.
Yep.
Um, and you answered this question already. One of them was the FHA, VA, and conventional. So all three of these will accept that buy down, and it could be used for any one of those loans, right?
Yeah, exactly. And you mentioned earlier about the 3-2-1 buy down. And so we don't
Yeah.
offer that one, but some people do. And it's the same format, right? The rate's 3 points lower than the highest, the note rate, right? Then it goes to 2, and then it goes to 1. So a 3-2-1 buy down, I don't know if they have a 10, 9, 8, 7, 6, 5, buy down.
That'd
But
be nice.
so the 3-2-1 buy down will be the same premise, except it's just 3 points or 3 percentage points lower on the rate.
Gotcha. Okay. Yeah. So this one lasts 2 years. The 3-2-1 buy down would last a total of 3 years.
Yep.
Gotcha. So after those 2 years, the rate goes, what rate, interest rate does it then default to?
Well, it'll go to their original note rate. So like whatever they qualify for today, like in this example, I'm using 7%. Whenever you're watching this, right, rates change every single day, sometimes 2 or 3 times a day.
Okay.
But in this example, it's 7%. You qualify for that today. Like if you were going to do a 30-year fixed mortgage, right, it's 7%. In this case, it's a 2-1 buy down. So after 2 years, that 7% note rate just kicks in, and you have 28 years left on the mortgage at 7%.
Okay. Gotcha. But then there's always the opportunity to refinance after those couple of years, right? If the rates are lower at the time.
Yeah. And so, like if you're a consumer watching this, you just you gotta be careful with the hey, I'll just refi it. So like, because and this is a little I don't know if should probably say this stuff, but like when it comes to rates, or is the market collapsing, is it not, or price is going to go up, they go down, rates going to go down, the stock market, right?
Yeah.
A lot of people are guessing, and so like you
Yeah.
got to keep that in mind. A lot of people are just guessing. We all think in our industry that next 12, 24 months that you're going to see a rate drop, but again, they're guessing. And so when you look at this type of loan, if you don't mind me saying kind of like who I think this loan is perfect for, you
Yeah.
mind if I say that?
Yeah. Go ahead.
So what I think is this loan type is really good. This type of buy down program for someone that's going to be in that house for a year, 2 years, maybe 3 tops. And because when you do that type of loan up front for those first few years, you are going to see as the buyer a ton of savings. But for
Yeah.
me, if it's going to be a long-term, like forever home, hey, we're dying in this house, right? One of those deals. If you have a seller willing to contribute $9,000 to you as the buyer, that money, and this is again where it becomes the borrower, right? Everyone's so different. We all have, you need to look at maybe that money is going to be maybe better spent buying down the 30-year fixed rate from 7% to 5.5 or something, 6 or whatever that buy down works out to be. And therefore your long 30-year payment may work out to be cheaper over the long run if it's going to be a forever home. And Frank, man, we have these conversations with people all day, and it's like, we don't know what goes on in their house between the, husband, wife, or by themselves, what their risk tolerance is, long-term plans. Like the consumer knows it, we're just here to advise them on it.
Yeah, absolutely. So basically what you're saying is it may very well be a better option to buy down the rate for the full 30-year period,
Maybe.
instead of just the 3 or the 2 years.
Well, and it depends on the market too, because right now what we have happening is, and it's kind of unique, and it doesn't happen a lot. In a normal market, what I've always seen is if a borrower wants to pay 1 point on the loan amount to try to lower their payment, you probably see about a quarter off the rate, right? So if I say I want to pay 1 point on a $400,000 loan, that's $4,000. And 1 point doesn't mean that the rate's going to go down 1 point.
Okay, yeah.
And so that it could normally it's about a 0.25% off the rate if you pay 1 point. But right now, for whatever reason, the way the market is, how crazy it is, that 1 point, that $4,000 gets you way more of a rate buy down. Like we're seeing it, almost 3/4 of a point at times.
Oh, wow.
Yeah,
Okay.
and again, it just depends on what the rates are doing at that time in the
Yeah.
market, and
Right.
if it
Right.
makes sense or not.
Yeah. So if you're watching this video, 2, 3, 4 years down the road, it might not make as much sense as it does today.
Right.
We're shooting 2023, January of 2023. So yeah, it's best to talk to your lender at that time and see which option works best for you, and
Mhm.
take it, do it that way, and play it by ear that way, because we never know what the rates are going to do. We don't even know what they're going to do in this afternoon, right? So
No, sure don't, man.
yeah, Jerome Powell can get up there and say, oh, inflation's too high. We're going to have to go ahead and raise the Fed rate again,
Yep.
0.75%, and then all of a sudden you get high rates again. But
We'll go even deeper. I mean, 2020, when
yeah,
COVID showed up, there was no one in their right mind thinking rates were going to go down in the twos, but they did, and like that was absolutely unexpected. No
yeah,
matter what your thoughts are on COVID and whatever happened, like rates plummeted and no one saw it coming.
you
And it
never
was a
know.
huge,
You just never
what's that?
know. You just never know.
Yeah, exactly.
Some
Wars and everything else. You just, so many things are going on out there.
Exactly, which it's the famous saying: if we had a crystal ball, uh, things would be much better, I guess, with a crystal ball. But none of
Right.
us do. We don't know what the rates, or we don't know what the markets are going to do. So yeah. So well, I think we kind of touched a lot of it. Do you have any other points that you wanted to touch on?
Yeah, just real quick, so they're aware. Just a couple side notes. No manufactured homes. Okay, you can't
Okay.
do this on manufactured homes. Credit score, you want to be a 660 or higher.
Okay.
And it's only primary residences only. So no vacation homes or investment properties.
Gotcha.
And that's for us. Okay, so that's for us.
Okay. Gotcha. And is this a kind of a federal federally backed loan,
Mhm.
or is it,
This is a Fannie Mae, Freddie Mac type
okay.
loan. Yeah, it's a conventional loan.
Oh, okay.
Or VA or FHA. And VA and FHA are primary residences only. So you can't do vacation homes or investment properties with either one of those loans. But
Right.
conventional, you can do vacation and investment properties, but not with a 2-1 buy down with us.
Okay. Okay, makes sense. Well then, if you got nothing else to add to that, man, I really appreciate your time today. Talking about this, it clears a lot of things up, not only just for my clients, but it clears stuff up for me too, because there's a lot of stuff going on about interest rates and the different programs to help kind of offset those interest rates. So I definitely appreciate you taking the time today to talk to me about this. And guys, this is Tim Hart with Vandyk Mortgage, my go-to mortgage guy. If you have any questions, he's your guy. We'll put his information and the link wherever I post this video, Instagram, YouTube, Facebook, all the above. So thanks, Tim. Happy New Year to you.
Same to you, buddy. Thanks for having me. And I appreciate the chance. Thank you.
We'll say that, right? It's we're only 12 days into the new
You
year.
can still say Happy New Year. Definitely.
Yeah, we got to figure out a cutoff for that one of these days.
I don't know. There's a rule. February 1, you got to stop. That's our new rule, Frank.
Yeah. All right. Well, we'll talk about that in another video.
There's some more content for you. When do you stop saying Happy New Year?
All right. Well, we'll do that. Appreciate you, buddy.
Thanks, man.
All right, man.
Bye.